Senhoras e senhores, bom dia.
Ladies and gentlemen, good morning. Welcome to the first annual conference of the Central Bank of Brazil. For the opening speech, we invite Dr. Roberto Campos Neto, the President of the Central Bank of Brazil, who will be participating online. Hello, good morning, everyone. I'd like to start by apologizing. I couldn't be with you. I had a small health problem, so I am speaking to you from my home thanks to technology. It is my pleasure to be a part of this conference after 3 years after holding our seminars. Having this first annual conference is a very timely moment for us to resume our discussions related to central bank activities. I will start with a history of the last 3 years, the factors that have contributed with the increase of uh, the global inflation and other relevant topics for the central bank in this period, themes that will certainly be addressed in this conference. Starting with the global context. Going back to the beginning of the pandemic in 2020, there was a strong uncertainty movement and instability of the markets. We knew that the economic shock will be great, even though it would not be possible to measure its size. In the attempt to try to compensate for the problems, the governments implemented programs of the economy and in a timely and coordinated manner among different national governments. In addition, the central banks have adopted measures that have generated a strong monetary impulse. The effect of this monetary movement made the great prediction of a recession into a moderate recession with the cash transfer programs and policies for mobility restrictions. Apologies. As a consequence of the economic programs of cash transfer and global policies of mobility restrictions, there was a reduction of services and increase in the consumption of goods. Particularly, the countries with more fiscal injection having presented the increase of consumption. The demand for goods has also generated the demand for energy. As a consequence, there was increase of consumption and prices of electricity. The increase of the demand for energy was not followed by a proportional increase of the supply. So there was a beginning of the global crisis. The central banks initially assessed that the increase of prices will be temporary. One of the reasons for that assessment was the expectation that there will be dislodgement of the consumption of goods into service consumption when the economies opened up again. There's like that, the prices of goods would drop, and the prices of services will be um, more difficult to rise. And we expected that the dynamics of these forces, the transition to the new balance, will result in the reduction of the inflation. We should highlight, however, that the central bank took long to understand the effect of the packages, the relief packages over the economies. There was some time before we understood that it was a dislodgement of the aggregated demand, and that this displacement should be more efficient than we imagined. The pandemic shock also showed us that the supply today is less adapted than we believed it to be. After the increase of the aggregated demand, the supply was not as reactive as expected. The concentration of value chains and few producers in countries made the interruption of the chains to impact the supply of goods globally. All of these aspects have affected the supply and demand with uh, serious effects in some sectors. And the war between Russia and Ukraine added pressures on these scenarios. There was a huge increase of prices of commodities, and this additional shock led to a change in the global inflation. About the fiscal consequences, the measures to support economic activity implemented during the pandemic had a huge impact in the debts of the advanced and emerging countries. At the wake of the Cold War, the governments have implemented measures to alleviate the impact of the increase of prices of energy in the families. These new packages have provided or have generated even more pressures on the debts, and the results of these occurrences, the financial markets showed little appetite for expansionist fiscal measures, especially in advanced countries. In the past, there was a clear difference between advanced and emerging countries with regards to the reaction of the financial market to the before the perspective of increasing debt. The appetite to risk was much smaller to the most indebted countries. Now, as we can see in some recent events, some advanced countries are having a similar treatment as the emerging countries. Another important topic that we have to discuss is financial stability. This topic has gained global importance lately with the bankruptcies of banking institutions in the United States and Europe. These episodes have raised attention for many risks, with more disseminated risks for the financial system at large. To this moment, these are very limited cases, but they must be monitored. The national and international authorities have been acted in a quick and coordinated manner, adopting measures to reestablish the confidence of the agents regarding the solidity of financial institutions at large. These episodes show that in moments of greater stress, the reliefs of banking accounts are potentialized because of the low cost with which people, by using modern technology, can transfer their funds among different institutions. And this is a marginal cost of transference between or among institutions by a very low cost. There was also the dissemination of information through social media and concentration of structures of deposits. And it's important that regulatory frameworks of supervision take into account these new risks. Regarding the action of the central banks, even taking into account the matter of the financial instability, the combat to inflation remains a huge challenge to the central banks around the world. The increase of inflation in the global level in the last years have led the central banks to adopt restrictive or tightening of monetary policy. The synchronization is something that calls attention. According to BIS, we have never seen such a high percentage of central banks adopting monetary policy in the same direction. With regards to Brazil, the Central Bank of Brazil was one of the first central banks to start the monetary tightening in March of 2001, and this was due first to our perception of the current inflation and the fact that the inflation in Brazil started to increase before it did in other countries. From the start, we had a different perspective of the current inflation. When some saw the inflation as something deterrent from the restriction of temporary supply, we saw the inflation as a persistent demand-based component. In addition, we know that in the case of developing countries with the history of inflation, the strategy to wait until the indicators suggest an increase of inflation, they all present a higher risk of making the inflation higher and more volatile, deteriorating the expectations of future inflation. We consider that this proactive uh, measure was very timely, and our strategy starts to present results. The inflation in Brazil started to reduce relatively sooner than when compared to other countries. The second semester of 2022, the main factor in the reduction of the inflation was the reduction of taxes. So the tax cuts on fuel, electricity, and telecommunication services. But the reduction of inflation can also be noted in the cycle of tightening of the monetary policy endeavored by the central bank. The IPCA fall to 4.2% in April of 2023. prospectively speaking, the inflation projections of the central bank is 3.8, 3.6, 3.2 to 2025 until 2025. As we argued, the process of disinflation should continue, but in a non-linear manner. The nuclei of inflation are more resilient given the diffusion of the inflation among the different sectors and underlying pressures that are still strong with more rigid components on the services. Therefore, the speed of deflation should be slower in this second step, both in Brazil and other countries. It's important to highlight that even though we have progressed so far, we still face challenges to consolidate disinflation in Brazil. Since the end of 2022, the expectations of the market to 2023 have increased substantially. The expectations for 2024 and 25 that were uh, stable are now disanchored. These are based on the questionings about the changes of the targets for future inflation, especially in the domestic policy in the fiscal realm. The anchoring of expectations is essential, and decisions that induce the re-anchoring of the expectations that it will increase the confidence in the inflation targets will contribute for a quicker and less costly deflation process. The new fiscal framework adopted by the government can help. We consider that the new rules avoid most extreme scenarios of public debt, but there's no mechanical relationship between the monetary policy and the fiscal framework, the tax framework, because it is still conditioned to other macroeconomic variables such as the expectation of macro economy and inflation and the assets prices. And as this conference was born with the framework of targets for Brazil, we should remember that this current tax regimen and targets for Brazil has been good. It's solid and it services different phases of the economic structure and provides for the anchoring of the expectations. The stability of the framework is based on its stability because it does not change due to the economic situation or cycle of monetary policy. In summary, in the recent period, the shocks faced by the different economies have presented a global nature pointing to same direction policies. This conference is an opportunity for us to discuss the lessons learned, the specificities of the solutions of each of the countries, and also for us to assess the challenges and opportunities that we have ahead of us. I am certain that we will have a very productive and fruitful conference with presentations by the central banks, and I wish you all a good conference. Starting with our agenda, I would like to invite the head economist from the IMF, uh, Gita Gopinath, for our keynote speech. Thank you very much, and I'm very sorry once again for not being there with you in person. Translation apologizes. The speaker was reading and we did not have access to the text, so the pace was very fast. We did the best we could. Thank you very much, President Roberto Oliveira Campos Neto. We would like to inform you that the next lectures will be followed by Q&A sessions conducted by our moderators. As President Roberto Campos said, we'll have our keynote speech. For that, we would like to invite our moderator, Diogo Abriguilan, Director of Economic Policy in the Central Bank in Brazil, and Ms. Gita Gopinath, first Deputy Managing Director of the International Monetary Fund. We give the floor to Mr. Diogo Guilan, the moderator of this session.
I will speak in English just to help her.
Audience joining us online. I would like to welcome you to the first annual conference of the Banco Central do Brasil, and welcome our keynote, Ms. Gita Gopinath. Ms. Gopinath has a master's degree from Delhi School of Economics and the University of Washington, and received a PhD in economics from Princeton University. She was an assistant professor of economics at the University of Chicago's Booth School of Business and professor at Harvard University's economics department. Her research has been widely cited and has been published in many top economic journals. She was a member of the Economic Advisory Panel of the Federal Reserve Bank of New York and a visiting scholar at the Federal Reserve Bank of Boston. In the IMF, Ms. Gopinath served as the chief economist of the fund from 2019 to 2022. In that role, she was the economic counselor of the fund and director of its research department. Since January 2022, Ms. Gita Gopinath has been the first deputy managing director of the IMF. The floor is yours. Thank you so much.
Thank you. Thank you, Diego, for that kind introduction. And it's a real pleasure to be here at the Central Bank. This is my first time in Brazil, so I'm very excited to be here. Thank you. So I'm going to talk about how to tackle high inflation in emerging markets. Clearly, fighting inflation is the top priority of central banks around the world. Governor Campos Neto also made that very clear in his remarks. That said, this is clearly not an easy task. We are seeing growth slowing and also seeing events of financial stresses. So I'm going to spend some time talking about the challenges that emerging markets specifically face in bringing down inflation, which is running at multi-decade highs. So in this context, I am going to touch on, I'd say, 4 questions, right? The first is, what accounts for the solid performance of emerging markets in an environment of very rapid increase in interest rates in advanced economies? Second, what is the appropriate strategy for bringing inflation down, given that core inflation remains highly sticky, not just in advanced economies, but also in emerging markets? And third, how should emerging markets central banks respond to financial stresses, which can pose difficult trade-offs between price stability and financial stability? And the fourth question is on the role of fiscal policy, which is, what role can fiscal policy play in the fight against inflation? So there are 4 questions. I think these are some of the big questions of the day. I don't have all the answers, but I'm going to provide some insights, and I look forward to having a good conversation after that. So to the first question about, what is different this time in terms of how emerging markets are responding to the big increase in interest rates. So we've seen a sharp tightening of monetary policy in advanced economies. And in the past, we know that whenever this happens, and especially when interest rates go up sharply in the US, it has triggered financial stress and even crisis in emerging markets. And the reason this happens is because global investors view emerging markets as riskier in terms of credit risk and currency risk. And so when interest rates go up in the developed world, and they're considered to be somewhat safer assets, then investors pull out very quickly from emerging markets. I should move my slides. So this was the case in the 1980s, and again in the mid-1990s. At the time, investors had several concerns about emerging markets. They were concerned about the high levels of debt. The debt tended to be short-term in duration and denominated in foreign currency. International reserves were low, and policy frameworks were not particularly strong. So these were some of the reasons why we saw a lot of stress during those periods. The recent tightening cycle has played out very differently. You can see that on the chart here, if you see the left graph, because of rising domestic inflation, emerging markets on average tightened monetary policy starting in the middle of 2021, much earlier than advanced economies. And again, as the governor said, Brazil was ahead in terms of recognizing the persistence in inflation that could come from high levels of demand. So they were one of the first central banks to raise interest rates. Now, we have an environment where interest rates have gone up sharply in emerging markets, and you can see that if you just look at real interest rates. I mean, those are very positive real interest rates in the 5 Latin American nations. That's the LA5 group. And you've seen interest rates now go up sharply in the US and Europe. And despite that, emerging market economies have proven fairly resilient to their own policy tightening and to spillovers from the tightening in advanced economies. Emerging market growth remains strong through last year and is expected to hold up. Of course, you expect to see some moderation, but it still is holding up well. And capital outflows, which is usually a trademark of such periods, has been quite limited. So outflows from Latin America, for instance, and this is what you see on the right graph, have been far smaller than during the taper tantrum of 2013. And if you look at some emerging market currencies, they've even appreciated. Some of them have benefited from the increase in commodity prices that went up last year. So I guess that's the question, is that what accounts for this strong performance of emerging markets? One critical factor, and I would like to argue, is the reforms. Emerging markets have put in place over the last couple of decades reforms that have helped lower both credit risk and currency risk. EM central banks have improved their monetary policy frameworks and benefited from greater independence. They've moved towards greater exchange rate flexibility and transitioned from using the exchange rate as a nominal anchor to flexible inflation targeting, which is what you see on the left graph. Higher policy transparency has also allowed investors to determine risks better and be less prone to fleeing during periods of global financial tightening. The success of emerging market central banks at delivering low inflation has helped anchor long-term inflation expectations around the announced targets, as you can see in the right graph on the slide. Long-term inflation expectations are much less sensitive to near-term developments, and there's less variance of long-term inflation forecast across different analyses. So this is an indication of the reduction in risks that are seen from external investors and domestic investors. So while building monetary policy credibility is an ongoing challenge, emerging markets are better prepared for the formidable task of tackling today's high inflation. Emerging markets have also made important strides in enhancing financial stability. This includes ensuring that emerging market banks are better capitalized, something you see there on the left graph. In addition, they have taken more steps to strengthen regulatory, supervisory, and macroprudential frameworks to limit risk-taking and foreign exchange mismatch. At the same time, emerging markets have implemented structural reforms to encourage the development of local currency bond markets and build sizable buffers of foreign exchange reserves. That's what you see on the right graph. This has reduced the risk of debt default from FX borrowing. In addition, emerging markets have also benefited from improved fiscal frameworks that have strengthened debt sustainability. So these collection of reforms on monetary policy, the financial sector, and on fiscal policy have all served emerging markets well so far. Now, I do want to leave it with the caveat that this is not over. the fight against inflation is not over, and interest rates are high and may need to go higher in certain countries. Therefore, it's important to remain mindful that there are considerable downside risks from monetary policy tightening, and there could be spillovers in the future to emerging markets. So it is important for policymakers in emerging markets to remain vigilant and maintain all the best practices that they have followed to maintain resilience to these kinds of shocks. So now moving to the second question, which is tied to the inflation outlook. If you look at how financial markets are assessing inflation in several countries, including advanced economies, but also in emerging markets, is that financial markets seem to be quite optimistic that inflation will come down fairly quickly. Now, while there's actually considerable divergence across emerging markets in their inflation rates, markets expect inflation to decline fairly quickly to target across emerging markets, without much of a hit to economic growth. And they expect lower inflation will allow emerging market central banks to begin making rate cuts later this year. Now, despite this optimism, inflation in emerging markets has been high and persistent. This is what you see on the left graph. So in fact, inflation, if you look at inflation realizations relative to what was expected, inflation is mostly surprised on the upside. Now, while goods inflation has declined sharply or even turned negative in some countries, inflation in services has been strong, which is what you see on the right graph. Moreover, policy tightening hasn't cooled labor markets significantly, and wage growth remains robust in many emerging markets. I think this feature is this collection of features, which is one, that markets expect inflation to come down relatively quickly and therefore central banks can cut rates, that we still have fairly tight labor markets in many countries despite interest rates going up, it seems to be a very common feature that we see in our surveillance across countries. So the question is, what do we need to do? Like, what should monetary policy strategy look like? Now, I'm going to start by saying that we don't really know fully what accounts for the stickiness of inflation, right? And I think this is a great question for future research, is to figure out what's driving this persistence, especially in core inflation. But I'm going to put forth several factors that likely play a role, and importantly, argue that these factors pose an upside risk to inflation going forward. So first, while monetary policy has tightened substantially in many emerging markets, like I said, activity has actually it's slowed a little bit, but had still been fairly resilient, and unemployment rates are near historic lows in many countries. Now, we know that monetary policy works with long and variable lags, and the full effects are yet to be felt. But I think there is a good question to be asked about whether the transmission of monetary policy has changed this time around. And there could be reasons for it. One is we could still have the tailwinds to growth that come from strong pent-up demand following the pandemic, and strong balance sheets from earlier fiscal and monetary policy support, both of which could be reducing the sensitivity of economic activity to interest rates. A second factor could be that we've seen a strong rotation of demand from goods to services. This can also generate persistent inflation pressures because we know that services demand tends to be less interest sensitive than demand for durable goods. And services tend to be more labor intensive, and wage growth, as we've seen, is unlikely to come down quickly. Third, if I look at supply side factors, it seems likely that the pandemic has lowered potential output and employment, which would tend to increase upward pressure on both labor costs and inflation. And we've seen supply chain disruptions. It's taken a while for supply chain disruptions to fully unwind. We're just now seeing a return back to pre-pandemic levels of flexibility in supply chains. So while there is considerable uncertainty around the inflation outlook, and there are both downside risks and upside risks, given that we don't completely understand where the persistence is coming from, I'm more concerned than markets are about sizable upside inflation risks. There are few historical precedents, if any, for inflation coming down from very high levels without a significant economic downturn. So the fact that labor markets and activity remain quite strong suggests that we may see considerable upward pressure on inflation. Now, these upward pressures could intensify if the natural rate of unemployment, the so-called U-star, has been significantly increased. Now, it's difficult to measure what potential output is and what the natural rate of U-star is, but there are arguments that potential employment and output could have fallen more than estimated following the pandemic. And that could again then pose an upside risk to inflation. There's also reason to be concerned that when you have sustained high inflation, it could change inflation dynamics. Rather than just absorbing increases in factor costs into their profit margins, firms would feel more comfortable passing them on, and workers would demand payback for the real wage decreases that they have experienced. So in other words, the longer inflation stays high, the harder it may become to bring it down, and the larger contraction of output that may be required. Because if you look at projections of inflation coming down in many countries, it doesn't happen until 2025 to come down to target. That is a long time. That's many quarters from now. And so the risk that inflation dynamics could change is an important one. And this risk is especially relevant for emerging markets, where inflation expectations are somewhat less well anchored, and wage and price indexation are more prevalent than in advanced economies. And these economies are also vulnerable to upside inflation surprises, given that the pass-through of exchange rate and energy shocks to core inflation tend to be somewhat higher. Now, to be clear, we have seen a decline in the overall level of pass-through over the last couple of decades, but it's still higher than for advanced economies. So all in all, there's a strong rationale for central banks maintaining a tight policy stance and reacting aggressively to upside inflation surprises. Now, structural models offer some insight into these challenges. Models show that the policy reaction function should become more aggressive in responding to inflation when inflation has a substantial backward-looking component that could reflect formal indexation arrangements or adaptive expectations. In these situations, positive demand or cost push shocks could have longer-lived effects. Now, it's helpful to consider optimal policy in a simple New Keynesian model with backward indexation that drives persistence. And you can see a couple of equations there, which is that the persistence parameter for inflation is I subscript P, and the output gap is X. And the policymaker is assumed to minimize a loss function that depends on the variance of the output gap and inflation. The optimal reaction function calls for pushing output below potential to a greater extent when inflation is more persistent. Now, this scenario illustrates the problems that may arise if monetary policy reacts to an inflation shock, using a rule that is optimal when inflation persistence is quite low, when in fact the structural persistence is actually much higher. And that's what you see on the right graph of the graphs that you see here. The fairly passive rule, which is shown by the red dashed line, allows inflation to rise by much more than the rules-based one that would be using the correct persistence parameter, which is what you see by the solid blue line. Now, output losses are somewhat smaller initially under the more passive rule. Such a rule leaves the central bank, however, with a bigger inflation problem. And if the policymaker catches on after some time and follows the optimal rule with the correct persistence parameter, inflation can be brought down faster, but it is much more costly in terms of having a deeper downturn. So again, it is important at this point, given the upside risks for inflation, for monetary policy to maintain a tight stance for the duration that it's needed to be kept high. Now, moving on to the third question, which is on monetary policy and financial stress. As I started out by saying that major emerging market economies have done well in weathering both their own policy tightening and the tightening in advanced economies, but they could still be hit by financial stress. Now, these stresses may affect emerging markets differently, right? It doesn't seem likely that the events that happened in March in the US in terms of the Silicon Valley Bank is what a stress event would look like, for instance, in emerging markets. So I think it would have different characteristics. They would affect emerging markets differently, where in the US we had large unrealized losses due to duration mismatch that unnerved investors and precipitated bank runs. Emerging markets can be more exposed to credit risk and exchange rate risk arising from slowing domestic activity or capital outflows that increase sovereign vulnerabilities. Now, pressures are also heightened from borrowing in foreign currency, especially when that borrowing is done at a short horizon. The emerging market central banks have ways to reduce these tensions between price and financial stability objectives. These include preemptive tools, such as macroprudential tools, preemptive CFM-MPMs, but also tools that can be used in the event of stress, such as long-term discount window, lending, repos, asset purchases, and lending in foreign exchange, which is sometimes supported by central bank swap lines. Now, many emerging markets provided liquidity support during COVID and found these interventions to be effective at reducing financial stress. However, like advanced economy central banks, they need to be careful how they use these tools. Expanding their balance sheet while fighting inflation could firstly lead to some confusion about the stance of monetary policy. It could heighten exposure to credit or maturity risk and raise political concerns about picking winners and losers. Accordingly, it is important to put a high bar on such interventions, ensuring they are temporary and targeted. Emerging market central banks could also face mounting external pressures, including if global financial conditions tighten sharply, causing an exit from emerging market assets. I don't expect you to be able to read everything that's on that slide, but it is basically a graphic of the fund's advice as part of the integrated policy framework. So the fund's integrated policy framework is helpful in identifying conditions under which foreign exchange intervention and capital flow management measures may be helpful in improving the policy trade-offs facing central banks. Fund staff have developed and applied both conceptual and more quantitative models to illustrate how these tools should be used, and research is ongoing. Now, very broadly, firstly, it's very important to recognize what is driving the rise in interest rates, what's generating the movements in asset prices, right? So the tools should be guided by careful analysis of frictions and nature of shocks. Allowing the exchange rate to adjust flexibly is desirable if FX markets are reasonably deep. The shocks are mainly to fundamentals such as commodity prices, and the risk of financial stresses is modest. The case for FXI, foreign exchange intervention, is stronger if FX market depth is low and the economy faces external financial shocks associated with deteriorating investor sentiment. However, even in this case, the central bank must recognize the intertemporal trade-offs involved in using FXI to support the exchange rate, including the risk that it may compromise its ability to provide liquidity support in FX. Thank you. Moving on to the last question that I put on the table, which is the role that fiscal policy can play in bringing down inflation, in helping bring down inflation. Some of the side effects of fighting inflation with monetary policy, including the financial stresses that I just mentioned, can be reduced by allowing fiscal policy to play a bigger role. Governments can prioritize the needs of the most vulnerable while scaling back broad-based fiscal support that isn't warranted in a high inflation environment. IMF staff are using both empirical and structural models to assess how fiscal policy can help the fight against inflation. This slide basically shows the results from a stylized two-country DSGE model that considers two different approaches to lowering inflation. The first relies exclusively on monetary tightening to cool the overheating economy, whereas the second involves fiscal consolidation, so a combination of monetary and fiscal. The scenario calibrates the monetary and fiscal tightening so that the GDP effects are essentially identical. Both approaches are clearly effective in lowering inflation, as you can see on the left panel. However, they work through different channels. Monetary tightening reduces demand by boosting interest rates and causing the currency to appreciate, while fiscal tightening cools demand without the need for interest rates to rise. In fact, interest rates can also fall somewhat, as you see in the middle panel, and the currency tends to depreciate. Importantly, monetary tightening causes government debt to rise given the high debt servicing costs and adverse effects of the economic slowdown on the primary balance, whereas government debt falls in the case of fiscal consolidation, which is what you see on the rightmost panel. So conversely, broad-based fiscal support would either force the central bank to slam on the brakes to curb inflation or cause inflation to rise more, potentially leading to de-anchoring if the central bank chooses to accommodate that. Public debt would eventually increase under either approach, but especially under the more forceful monetary policy tightening. So broad-based fiscal expansion is counterproductive for economies fighting high inflation, especially emerging markets. Analytical work by the IMF staff, including in the Fiscal Monitor and the Global Financial Stability Report, shows how higher public debt in emerging markets makes them more vulnerable to sovereign default and tends to raise sovereign spreads, as you see on the slide. Weak fiscal positions can heighten the risk of an adverse sovereign bank nexus in which declines in sovereign bond prices hurt the banks, and the weaker macro outlook in turn undermines the sovereign's credibility. Now, weak fiscal positions can also increase risks of fiscal dominance, especially in an environment of high inflation, where the fiscal authorities may fear that tight monetary policy will further weaken public sector balances and the macroeconomy. IMF research has shown how deteriorating fiscal positions in emerging markets tend to put upward pressure on long-term inflation expectations, complicating the task of monetary policy, which is what you see on the right graph. So all told, fiscal restraint can mitigate the challenges of bringing down inflation and reducing financial vulnerabilities that make the fight against inflation even harder. So now I'm going to conclude. I've argued that markets are probably too optimistic about what it will take to bring inflation down in emerging markets and also in advanced economies. Despite encouraging signs, I am worried that price pressures seem entrenched in many economies and the upside inflation risks are sizable. Hence, central banks must remain resolute in keeping inflation, keeping their monetary policies tight, and recognize that insufficient monetary tightening may necessitate even more painful action later. This is the lesson that we learned from the high inflation of the 1970s that very much applies today. Fiscal restraint can help support the fight against inflation by central banks, and financial tools can improve trade-offs in the event of pronounced financial stress. Now, while these challenges are global, they are heightened for emerging markets. Hence, it is critical for emerging market authorities to continue to refine and strengthen their monetary, fiscal, and financial policy frameworks. Central bank independence should be maintained alongside further enhancements in transparency and communication. Better policy frameworks, as I mentioned earlier, have allowed emerging market central banks to pursue counter-cyclical policies during both the global financial crisis and the COVID pandemic. These frameworks have helped emerging markets hold up well in the face of the sharpest tightening of monetary policy in advanced economies in several decades. And they should continue to serve as an anchor of stability to help navigate the challenging road ahead. Thank you.
Thank you so much. Very clear, very thoughtful. Let me start with my own question, but feel free for the ones who want to ask too. So you mentioned the upside risks on inflation in many aspects. One was related to the labor market being strong with not much slack. The other one related to possibly a potential output that it's lower than before the pandemics. My question would be, how much of these upside risks you think are cyclical and how much of them are structural? So things like deglobalization and changes on the labor market. And from there, I guess the follow-up question would be, as you were saying, that markets are optimistic on how to bring inflation down, the need for restrictive monetary policy, the need for fiscal and monetary policies helping on bringing inflation down. So what is your scenario for growth on hard landing, soft landing, this whole discussion, sort of global, just thinking about these questions?
Yes, thank you. I guess turn off the slides. It could be distracting. So, the question is, do the factors that are now generating high inflation, how much of it do you think will last for long? I would say that there are several, of course, that are temporary. We've already seen, for instance, on the supply side, we've seen supply chain bottlenecks basically go back to pre-pandemic levels. For instance, if you look at transportation costs and the delivery lags and so on, those indices are basically back to where they were pre-pandemic. We are seeing labor force participation return. It's come down slowly. It's come about slowly, but they have returned. In the US, for instance, if you look at the prime age worker group, basically they're back to pre-pandemic trend. If you look at 55 and above, you certainly do have the early retirement, and that is more sticky. And then there is evidence of long-run effects of COVID on people who've contracted it, and that's not a small number, so that can have some negative effect for somewhat longer, at least. And then an important part of the inflation is demand. It is the fact that we have households and firms in many countries that saved more during the pandemic. Some of it was just forced saving. And you have stronger balance sheets. And so that can generate this increase in demand, but we expect that at some point to moderate and to go back to the usual levels. There is the question about what the pandemic, and even more, I would say, Russia's invasion of Ukraine has done to some supply side factors, and that could have a more lasting effect. And this is what you pointed to, which is the risk of what we call geo-economic fragmentation. It's not what is there right now in our baseline, but it is a risk that the IMF has been flagging through multiple reports looking at the costs of bringing down, costs of having a decoupled world, which is quite substantial. The only thing I would leave with is the extent to which the pressures on inflation are temporary or persistent depends a lot on the credibility of central banks to anchor inflation expectations. And so far, what is good news, especially if we look at markets assessments about where inflation is headed, they're all headed back to central bank targets. If that were to change, even if the underlying structural factors may not be that lasting, you could end up with an unfortunate vicious cycle which keeps inflation high. Oh, you asked about the hard landing just more globally. I think what is remarkable is that every time data comes out, we are surprised on the upside by resilience. In many countries. I'm coming from Chile, and in the case of Chile, the first quarter surprised on the upside. In Brazil, the data that we've seen so far came out stronger than we expected a little while ago. The US still, I would say, has fairly robust demand. So there is the possibility, I think there is a narrow path for having a soft landing where, for example, the US avoids a recession. But it would be a very unique period in history that we could bring inflation down from such high levels without getting a much more larger impact on activity.
Thank you, Gita, for the brilliant presentation. So your last point was actually where I was going to ask you. So there's this big debate out there, especially in the US, related to maybe higher neutral interest rates in advanced economies. How do you see that debate? Do you think it's maybe too early to tell or not? And the last point is going back to the structural inflation pressures. What about the transition, the green inflation that will be with us for a while, the need to proceed with transitioning to a low carbon economy? Do you think that will be a maybe persistent pressure for inflation?
Thank you. Again, two questions for which we need to learn, do a lot more research on. We've actually looked into the R-star, the natural real rate of interest, and where we think it might land. So of course, right now, real rates are high, and which points to the fact that, one, it is likely that we have a temporary period of the natural rate being higher, but also a reflection of the fact that you're trying to bring the, slow an overheating economy, so you do want to keep real interest rates high. But we did look at this, and there's a chapter in the recent World Economic Outlook where we give our best estimate of where we think R-star will return to, say about 4 or 5 years in the future, subject to the fact that there is no de-anchoring of inflation expectations, which means that central banks and policymakers more generally get the job done. Our best estimate is that we would return to a world of low R-star. So, around the level that we saw pre-pandemic. And the reason for that is if you calibrate the models and you feed in the factors that have generated low R-star, like aging demographics, inequality, those factors remain and weigh on R-star. The question is, for instance, what would something like geo-economic fragmentation do? If geo-economic fragmentation, one were to reasonably assume, would reduce productivity growth, then that also weighs against a higher R-star. We would expect R-star to stay lower. Now, there are factors that might move us in the other direction, that could move us in the other direction. One is the high levels of debt, public debt that we're seeing around the world. And if, again, fiscal stances stay expansionary for a long time, so there's much more government borrowing, then you could have R star going up higher. But again, subject to uncertainty, I would say that we would likely head back towards the kinds of interest rates we saw in the past. In terms of the impact of the green transition and the policies that are needed to make the green transition happen, the effect of that on inflation, so we've actually developed macro models now at the IMF, which allows for modeling the green transition. And one of the takeaways from that analysis says that the impact on inflation, which means the amount of inflationary pressures it generates, depends crucially on whether you do what you need to do now or you wait too long. So if you move quickly and you do it through a combination of carbon prices, regulation, green investment, subsidizing research and R&D in green transition, then we could have the transition happen with a minimal impacts on inflationary pressures. The problem is if you don't, and if you wait, and you don't have to wait that long, if you delay, for instance, by just another couple of years, you then have to slam the brakes. And you have to have your carbon prices, either explicit or implicit, go up quite sharply. And that can then put huge pressures on inflation. So again, I think the message is that it's urgent to move rapidly now on the green transition.
Hello? Hi. Gita, I was so sorry to miss you yesterday at Chile because I wanted to ask you a question, but here we are now, so I can try today. So as the governor said, and as you remarked on your presentation, I think I agree this time around, emerging markets, in particular Latin America, reacted relatively quickly to inflation, and this was helped by all the developments in reforms and transparency that certainly helped this process. If you look at the monetary policy rates today in Latin America, and you look at inflation expectations 1 or 2 years ahead, I mean, you can clearly see a case for inflation coming down. We have high real rates. We can have a discussion on where the natural rate is, but our current real rates are definitely above the natural real rate. You could even say that this is also true for the US, because at rates of 5% and inflation expectations at 1 or 2 years that are slightly less, even in the US, the real rate is positive. And in the case of the US, on top of that, you have, of course, all the, the risk aversion coming from the banking situation, and that also helps tightening credit conditions. So in the US, I think there's also a very credible case for inflation coming down. So my question to you, and I'm sorry if I put you on the spot with this, but I cannot get my head around with the situation in the Eurozone. So the Eurozone has an interest rate that when you factor in inflation expectations at a 1 or 2 year horizon, has not even reached positive levels. And I don't know what the estimate of the natural rate is in Europe, but it's not negative. So the story there, when you talk about with people, central banks in different countries in Europe, is that most of the inflation, even the core inflation, that is now running at close to 6%, is due to this huge energy shock that somehow, found itself into core inflation with a higher dynamic than usual. And as this inflation came, it will sort of vanish out on its own without the need to further tighten policy. And that would be a credible story, I think, except for the fact that the unemployment rate is also at record lows in the Eurozone. So this is the thing that I cannot get my head around. I mean, clearly it was a supply shock, but almost by definition, the demand shock has to have been larger for unemployment rate to be at such record lows. So what's the story for inflation coming down in the Eurozone if you have lower unemployment than neutral, and you are not even reaching a real rate at any horizon. So I guess that's my question. I don't know what you think about that. Thank you.
Yeah. I think what I would say is, as the ECB has communicated, they are not done yet. Unlike the US that has signaled that they are probably going to be on hold unless the data points to the need to raise rates further, the ECB has communicated that they're not on hold, and they are likely to raise interest rates more. So I think they will agree with you that their real rates are not where they need to be to bring inflation on at this point. I mean, one of the difficult decisions that the ECB had to make was that last year they were hit, the country, obviously, the region was hit by a very negative supply shock. And the expectation was that with the negative terms of trade shock, you would automatically get slowing in the economy. And the expectation was that the winter would be really bad. So you could, in fact, have a recession. Many projections had a rejection expected. And therefore, in some sense, they were a little more cautious about raising rates because they thought that some of the weakening in demand, or a lot of the weakening demand, would come automatically from the negative terms of trade shock. Now, that didn't happen. The weather gods were also good. We had more milder winters. They had good policies on building up storage. I think now, given where energy prices are and the adjustments that they have made, I think the demand component is playing a very important role. And the ECB has recognized that, which is why, unlike other countries that moved somewhat faster earlier, I expect that they will continue to do some more rate increases.
Fabio Bueno.
Hi, Gita. Thanks a lot. Going back, I guess, to the same issues, but I think Fernanda kind of stole my thunder. But you pushed U-star being higher as a possible explanation to what is happening. And I would argue that would be the case if you had a big slowdown in growth and a big increase in unemployment everywhere and no impact in inflation. But a different view would be that maybe now, not in 5 years from now, our star is much higher and the monetary policy is not getting anything done in terms of growth and unemployment. So why push our U-star higher rather than R star higher, at least for now? Second question, if I may. If I understood, you're making the point that since inflation inertia is higher, central banks have to be with tighter monetary policy for a long time. What will be the role of long-term inflation expectations in your analysis? So if long-term inflation expectations are anchored, should the central bank be tighter? If they are unanchored, should it be tighter? Or how would you think about that? Thanks.
Yeah. Okay.
Maybe
All right.
get a final round. Carlos and someone over there. Yeah. So Carlos.
Thanks, Gita, for the great presentation. So as you showed, inflation is high and central banks, are choosing to delay the convergence of inflation back to target, which makes sense after such a shock. Do you see discussions about, because this might be a long transition back towards target, do you see discussions about changing inflation targets around the world? How do you see this, the timing of possible discussions about changes to the target, or whether it's more common just to, stick to the official target, but just communicate that you're choosing to delay the convergence back because of the nature of the shock and the magnitude of the shocks that we faced? Thank you.
Hi, Gita. Good to see you after 15 years. So very interesting thank you so much for your brilliant presentation about what do we make of all of that, all of the shocks that are going on in the countries and what to do in terms of policy. It's nice to have like a policy prescription as you're trying to offer us. Like, look, guys, we should be very worried. Let's worry about not lowering interest rates because maybe inflation is going to be very persistent. But I think that there's a lot of heterogeneity within the countries, and I think also, I mean, I read the World Economic Outlook. I think that your projections for Brazil is like real interest rates, a neutral rate of like 2.5%, and we have like an 8 or 9% forward looking real interest rates in Brazil. So I wonder if we should make some gradual adjustment in this policy prescription if we are too high or not. I just wanted you to dwell a little bit more on that. Thank you so much.
Final question? Yeah. The mic here. Você pode trazer o microfone aqui, ó, no meio. Na quarta fileira.
Thank you for an excellent presentation. Now, in the last 4 years, there is a lot of debate on what has happened to the threshold level of inflation. Many think that it would have gone up. Many think that maybe it has remained same. So what is your thought on? Thank you.
Okay. How much time do I have?
5 minutes.
Okay. Oh, well, so we can go into all of this in great detail. So, all very good questions. So I think there is to the question of are real rates at this point, what should they be to bring inflation down? I think ex ante, if somebody told us that real rates were, say, 6% or 6%, say, in Brazil, or 2% here, what the impact of that would be on the economy, I think we would all probably say that it would have a very strong contractionary impact. So in a sense, I think what we still need to understand is how the transmission mechanism has changed, and I listed some factors for why this time could be different in the sensitivity of economic activity to interest rates. Given, if you look at the whole genesis of the inflation, and if I think specifically about the US, when inflation started going up in the US, and this is in core inflation and all of our favorite underlying measures of inflation, the unemployment rate was around 5%, was over 5% in the US. So there is a sense in which, at least temporarily, it appears that U-star has been higher. It doesn't have to be, of course, permanently the case, but we've at least seen something happen temporarily. In terms of how aggressively monetary policy should respond, it does depend crucially on how forward-looking inflation expectations are versus backward-looking inflation expectations are. Again, inflation expectations differ depending upon whether you look at it from survey data, from households, or market data. Market data clearly seems to be very forward-looking, and the good news is central banks have credibility that inflation will come down, and so that can help. So that means you don't have to worry that much about inflation persistence. But the point I want to make is that you can't take it for granted. If you live in an environment where inflation is going to be high for another 2 years, it's not obvious that we would be able to keep inflation expectations that well anchored, which is why it's important. Now, that doesn't mean that I'm telling all countries should do more. As we discussed, as was said, there are several countries that are squarely in very tight monetary policy territory, and we should expect to see the effects play out. But then there are others who may need to do more. I think in general, it's consistent with what I just said. It's very important for central bank credibility to be preserved. With inflation this high, it is important for everybody to believe that central banks are going to bring inflation down durably. So any action that's taken should be consistent with maintaining that credibility. I think we've learned some lessons, though, from what happened during the pandemic and post, and what we've seen in terms of inflation. For example, if you look at the revision to the Fed's monetary policy framework, that was done under the assumption that the risk was always that inflation was going to be too low, and not that it was ever going to be too high. And in that environment, you know, central banks were quite aggressive, even when, say, your inflation target was 2% and you had, say, 1.6% inflation. Central banks were very focused on sufficient liquidity to make sure that you close that remaining 0.3, 0.4% gap. I think what the last few years have taught us is that there can be nonlinearities in the so-called Phillips curve. And therefore, it's probably, you know, if we're getting that close to target, I don't think one should be, you know, having an extremely expansionary monetary policy stance at that time. So the risks of inflation getting too high are somewhat more than was expected in the past. Again, questions of heterogeneity in real rates and too high or not. And again, I think that first, the graph that I had there, which showed you what real rates are, and every expectation is for everybody to come back down over the next couple of years. You know, data obviously will be a guiding factor in telling you about how much to keep interest rates for how long, and that's the variable that we have to follow very closely. But my point is that at this point, given the resilience in economies, that markets are probably too optimistic, at least in assuming that interest rate cuts will happen this year, for example, in the US. And then on the question of the threshold level of inflation, I mean, I think ultimately inflation is an object that can be controlled by monetary policy. And so I don't think of it as a natural shift, that there's some sort of a structural thing that central banks can't control. It's, of course, important to understand what the underlying factors are that are driving inflation so that you get the inflation right. Because, you know, there is the reverse problem. When you have a situation where R star is too low, then you do have constraints on what monetary policy can do. You have the zero lower bound, you have the effective lower bound. And then you might have a harder time getting inflation to where you want it to be. But that's asymmetric. If the issue is that you want to bring high inflation down, you do have the tools to be able to do it. And as I've argued, it's important to use those tools in this current environment.
Well, I think we're closing here. Thank you so much, Gita, for joining us.
Agradecemos então ao senhor.
Thank you, Mr. Diogo Abriguilin, Director of Economic Policy for the Central Bank of Brazil, and Ms. Gita Gopinath, the First Deputy Managing Director of the International Monetary Fund. Ladies and gentlemen, we'll now have a short 20-minute coffee break. The coffee break will be served at the foyer of this auditorium. Thank you very much, and see you in a couple of minutes.
on the macroeconomy. I'll briefly introduce our speakers. Amir Sufi is the Bruce Lindsay Distinguished Service Professor of Economics and Public Policy at the University of Chicago Booth School of Business. He is also a research associate at the NBER and co-director at the NBER Program on Corporate Finance. He serves as an associate editor for the American Economic Review and was awarded the 2017 Fisher-Black Prize by the American Finance Association, given biannually to the top financial economics scholars under the age of 40. He was elected as a Fellow of the Econometric Society in 2022, and one of the main lines of research of Professor Sufi focuses on the role of household debt in macroeconomic fluctuations, which will be the subject of his talk today. Stein Claessens is Head of Financial Stability Policy and Deputy Head of the Monetary and Economic Department at the BIS. He also represents the BIS externally in senior groups, including the Financial Stability Board, the Basel Committee on Banking Supervision, and the G20. Within the BIS, he leads policy-based analysis on financial sector issues and oversees the work of the secretariats of the Committee on the Global Financial System, Markets Committee, and Committee on Payments and Market Infrastructures. He has also held previous positions at the World Bank, at the IMF, and at the Federal Reserve Board. It is truly a pleasure to have the both of you. We'll start with a presentation by Stein.
Thank you very much. It's a great pleasure to be here, to see familiar faces, and it's nice to be doing this in person after this interruption. I'm going to give a little bit of an overview of household finance around the world, so to speak. It's work that's based by colleagues within the BIS, although the views don't necessarily represent those of the BIS. And then talk about monetary policy, so building a little bit on what Gita already presented in terms of how we should think about monetary policy in the context of what is quite a heterogeneous picture in terms of household finance. And I think if there's one takeaway from my presentation is that it's very hard to generalize in this area because the financing structure differs so much, the debt structures differ so much, but there's also the heterogeneity within the country. So if anything, this is going to be an ask for more research along the lines that you probably already are doing. So with that introduction, let me start here. What do we know? Well, we know in part, thanks to work of Amir Sufi and others, very much about this issue, both within the US, but also around the world. With another colleague, I did some review of that. But it does mean that within the context of monetary policy tightening, which is now a global phenomenon, of course, we can see some quite serious implications on the household side on a macroeconomic slowdown. Now, in some sense, we want that, but we want to calibrate it properly, and this is the question that we're going to be addressing implicitly, explicitly. But it's also an unusual situation where we cannot draw that much on historical lessons completely, because partly we have seen public and private sector buffers being relatively large, following on the COVID, where we had, of course, a lot of fiscal and monetary policy support. And then lately, a new phenomenon is the financial stability risks that have come on top of that. So the point of the presentation is what's the current state of knowledge, what are the issues that we can then address with some reasonable analytical framing. And like I said, the importance is on the differences across countries. The data that I present are not only, of course, on EMEs. Unfortunately, we don't have as good a data on EMEs, so I'm going to have to draw quite a bit on advanced economies in terms of lessons. I will end up, in some sense, talking a little bit what to do today in the context of when stresses are building up, what can we do both on the macroprudential side as well as on other policy side. So private debt has increased over the last few decades. I don't have to remind you, this is the global picture. There's a big distribution, but it's a general trend that applies in many, many countries. We had a low for a long period. Things were very favorable. But if you go individual countries, it's also the case that the black dot is on the top of the range, which is the range is between 99 and 22. So in most cases, or in many cases at least, we're on the top, not all for all EMEs and not for all advanced economies. There are some advanced economies that did deleverage a little bit through this period following the GFC, the global financial crisis. But in many cases, we're on the top of the bars here in advanced and emerging markets in terms of debt level. Now, look at these ratios. We're talking about 100 to 250% of GDP, and some countries like Korea, and we're going to probably talk about it more, and China in the 200% range. So Brazil, in a relative sense, is doing quite well. It is somewhere in the 60-70%. Now that's fine, of course, you can have high debt with low interest rates, but you make yourself very sensitive to policy tightening periods. Now we don't have that many policy tightenings in this sample because we haven't tightened that much, so we're in that sense on uncharted water. But if you look at those that we do have, you immediately see that you're going to have a higher debt service ratio. We're using this term, the DSR, the debt service ratio, quite a bit here relative to your income, disposable income. But it's also the case that you see that debt itself is rising. So you may expect the debt service to rise, but as part of it, people have to end up refinancing in part. So the debt itself is increasing. So you see, and you have to look at both the left and the right-hand chart. The left-hand chart gives you the change, which is in a few percentage points. But in terms of the level, you end up with a significant increase over this period when you tighten during a monetary policy. So that is the overall private sector picture, and now I'm going to get a little bit deeper in terms of the household part of it. And there, the household part, there's a lot of variation as well. As I mentioned, there was deleveraging in the US following the GFC. You saw that as well in India and Great Britain and South Africa. But it's the exceptions rather than the rule, because many advanced economies saw a big boom in housing continuing after the GFC. They didn't have the same non-performing loans, etc., as a consequence of the housing bust, but they did deleverage continued afterwards. So Australia, Canada, you can think of Sweden, that's not listed there, the Netherlands, other ones. They're on the peak in terms of debt ratios in many countries. And it's true as well in Brazil and other countries where we've seen some increase, not to the same levels, but nevertheless in the percentage terms, increases there as well. Now, people will say, well, yeah, but you have a change also on the asset side, so that partly compensates for the large increase in the debt ratios. That's true, of course, and we have seen these increases. So again, you can look at the countries that I mentioned already, the Netherlands, Canada, US as well. Large house price increases or other forms, stock market increases. But not all of that is equally liquid, of course. So when you do have a debt service increase and you do have to start paying back your higher mortgage rates, or what is it, you're not going to be able to use that cash because it's not in liquid forms. It's in your housing wealth, or it is in your stock market for your retirement or in your pension fund. So it doesn't work exactly that way. Now, that is a story as we knew it end of 21, because the data lack, of course. But the buffers that the banks or the households and the firms have been building up over the past few years are starting to run down. Now, this is a little bit harder to get all the data and the same comparables. So I'm just going to show you here the US and the Euro area. And I'm going to show you in the little dot, the red dot is the gross savings rate. So that's the percentage rate in terms of gross savings. And I'm going to show you the share of liquid assets that's still there and the illiquid assets. And the one area to focus on is the liquid financial assets. These have really been declining over the last few quarters as these large stimulus from the fiscal and monetary side have been depleting. It's particularly the case for the US. So now we're coming at a point in which you can argue towards the end of the year, this calendar year, we may see this completely depleted. The euro area is a little bit behind, but even there we see the depletion happening quite a bit. So this smoothing pattern that we have observed so far is not going to be permanent. So we should expect major impact going forward. So the monetary policy transmission that we typically know is maybe lagging a little bit more in these particular circumstances, but it's going to show up. But it's going to have also this heterogeneity that we really should take into account. And heterogeneity is really dependent on how large your debt levels is. So if you do an impulse response, so you shock the monetary policy with, in this case, only with 25 basis points. So it's a very small shock, relatively speaking, to what we have seen to date. And then you compare those countries that have debt ratios on the household side above 75 compared to below 75, you see there's a big difference here in terms of the impulse response. So you're talking about 0.6% decline in consumption over 16 quarters compared to almost nothing or 0.1 or so. Now, multiplying is not exactly what we can do, because otherwise we would say let's increase it by 20 times, because that's what the increase in de facto has been in interest rates. There are some nonlinear effects, I'm sure, as well. But nevertheless, the impact is going to vary a lot on where you are in terms of your debt ratios. The other heterogeneity I want to stress is an important one as well, which is the home ownership. Home ownership varies quite a bit across countries. It's a part of function of your mortgage markets, of course, so that makes you able to buy a home much easier, of course. But that's not everything that explains it. There's a lot of traditional factors where there are some home ownership that's very high because people tend to pay in cash. So Italy is always the prime example. If you look at home ownership in Italy, it's very high. You're talking about 60, 70%. However, very few people have a mortgage because the tradition in Italy is that you pay in cash now. It's not necessarily the rational thing to do, as opposed to the other countries that I mentioned, again, US, Sweden, the Netherlands, where that ratio of home ownership is equally high, but the mortgage is more or less a factor of 10 times as large. So big differences there as well. Again, that's going to make a difference of how the monetary policy and adjustment is going to be transmitting itself to the households in terms of their consumption patterns. The related factor is adjustable rate mortgages. So these differences are almost impossible to explain across countries. Institutional factors, let's say take the European context. We have one monetary policy, we have difference in legal systems, yes, we have different in banking systems, but they can explain that in some countries you have more or less only fixed rate mortgages, and other countries like Spain, at least it used to be the case, was largely variable. The UK is a prime example where there was a lot of variable rate as well. Now things have improved in the sense they've moved away from variable rates over the low for long period. So we have seen a decline in adjustable rate mortgages across most countries. But nevertheless, there are still these large differences in 2021, which is the latest data that we have, the green dot, across those countries. Makes a huge difference of how monetary policy gets transmitted. The US case is always a prime one. In some sense, people don't have to refinance their mortgage. They're sitting on a nice 2-3% mortgage rate today. They have their house. They're not going to be willing to sell it because they would actually then have to refinance it at a very high interest rate. So the whole adjustment mechanism correspondingly differs a lot. And again, you can do the same thing. This is based on a slightly more calibrated model, so it's not an impulse response per se, but it's taking your whole heterogeneity into account, considering both the differences in between variable rate debt and fixed rate debt. You can almost think of it as Germany versus Spain. Germany being relatively low, as I said, on home ownership, but very good on low mortgage rates, whereas Spain is very good on ownership as well, but has a lot of variable rate mortgages. Now immediately what you see is that country B, which is obviously Spain, has a much bigger impact of an equal increase, because it's always within the Eurozone, of course, increase in the monetary policy, when you're talking about a tripling or even more than that impulse response of a tightening for the same amount of a monetary shock. This heterogeneity makes everything very difficult, so in that sense it's hard to generalize what we need to do in terms of monetary policy. The additional difficulty is that there is a large distribution, and I'm sure we're going to hear more about from Amir as well, that the DSR, the debt service ratio, tends to be higher among the low-income households. They tend to borrow relatively more. They have saved less. Their income is less. As a consequence, given that they also have a higher marginal propensity to consume, it's going to hit both them and the economy, of course, much stronger. So, and here, if you look at the US and Euro area, the differences are not, I don't want to stress the differences because they're not that large in the end, but there is this heterogeneity across both economies, across both jurisdictions, in terms of who owns the debt and who has the higher debt service as a consequence. And you see that it's very left skewed in the sense of that the lowest percentile, the 20 percentile, has a debt service ratio above 40% in 20% or more of the cases. So it's a lot higher impact for this part of the household. Now, given you the heterogeneity on the household side, I want to also give you the heterogeneity on the private sector, non-financial corporates, so the other debts. And again, we see very similar patterns. They're not exactly the same, but they also have risen, obviously, in the low for long period. So we see the same, in this case, the yellow dot is on the top of the bar chart every time, or most of the times. And here, actually, the emerging markets that come to the forefront, including Brazil, stand out in the sense they have actually relatively increased even more so. So the corporate debt is more of an increase in the emerging market, including externally in many cases, which of course gives you some very specific issues as well. Now I can give you the whole kind of analysis on the corporate side, and I will do that in a second. But let me first tell you, why would we have to worry about the corporate sector in the first place? And it's not the case that we haven't seen crises that were not due to corporate sectors, including in emerging markets. So East Asia was a prime example, both Indonesia as well as Thailand, but also transition economies before then were also cases in which the corporate sector was actually driving the losses in some sense. And we may have been a little bit skewed by the COVID experience, in which bankruptcies have been relatively low, actually statistically way below what we would have expected on the basis of recessions, given the support. And in addition to that, and this is not the result of the BS, but of people like Oscar Jordan and others, and Schulkener, that in countries where the frictions of renegotiating debt are high, the corporate sector could and is actually been found to be a driver of financial crisis. And exactly that, the renegotiation cost is what makes it such a drag on the economic activity and calls for a recession and even a crisis. So we need to worry about the corporate sector as well. So let me gonna give you quickly the review on their developments. And again, very similar patterns. So an investment response is the more appropriate measure to take here. And the investment response is also much sharper. Actually, it recovers relatively quickly for those low debt economies where the NFC, the non-financial corporate debt, is relatively low. But it's not the case for the ones where there's a high corporate debt when you tighten about 100 basis points. Same on the asset price side. So if I look at spreads, this one is harder to do because we don't have spreads at a disaggregated level sufficiently for many countries. But you see the same effect. A tightening is much more important, even, let's say, in the US, when you distinguish the US between low and high corporate periods, the impact on spreads is much higher in the high debt period, the more recent periods. That applies for the Eurozone as well as for the UK as well, where there's an increase in the spread in the 1 to 2 year rates of quite a bit more. Now, are there some mitigating factors? Well, yes, there are some mitigating factors. One is obviously how much variable debt do we have in the particular economy, in the particular time period. Here the period is as well beneficial. The low for long did lead to a reduction in the variable rate debt. So the latest number here is the bar, which is below the dot in most of the countries, not in all of the countries, in many of the countries. So people did refinance and extended their maturities as well. That is shown up in the slide of the short-term debt. You see a lot less short-term debt, less variable rate debt, as I showed before. So the combination of the two is a good one. But nevertheless, there is a maturity wall that is coming up that is quite significant in the next 2 years. These are the numbers. I'm not going to discuss them in details. And this is already 21 data. I think people are really expecting 23, 24, 25 to be a significant maturity wall in the sense that corporates have to refinance large fractions of their existing debt. Last point here, people will say, well, you can hedge. Yes, it's often not the case that corporates hedge. So if they were to do that, that would help. But that's more the exception than the rule, I would say. And if you don't hedge, then you see the same pattern that I showed you before. The impulse response, the decline in investment is much, much larger if you don't hedge. So where does it leave us? It leaves us with worries. Now maybe I'm from the BS and we always worry about things, so I should take that with a grain of salt. But nevertheless, I think it's pretty obvious that financial stability risks are increasing. It's hard to make the opposite argument, so I think I'm on safe grounds here to say that there is a worry. Historically, again, and particularly the combination that we see today, I mean, high interest rates and high inflation and high debt levels is a rare combination. We see that today. If you were to go back to these various combinations of credit to GDP, inflation, and the change in inflation, you have a hard time finding it historically anywhere. You can see it. Everything has been going up and inflation has been going down. So the combination is a rare one. So we should take that into account when we see the current problems. Nevertheless, if you take an historical perspective on what we might experience if we go through this period of monetary policy tightening. So let's take all the cases that we know in both in advanced and emerging markets over a long period since 1970, and we look at the hikes, and those hikes historically have been actually much less. I mean, you look at the distribution, the chart in the middle, look at how large the hikes have been. The times that there were more than 5% are very, very rare. We've seen already many advanced, or at least in some advanced, but in many emerging markets, hikes that are much more than that. So we're already in uncharted water on the hike side, and maybe also on the duration side. Let's see how long we have to stick with the high interest rates. Now, if you see this unusual combination, what could we expect in terms of financial stress? And I think there the story is fairly clear. So you look at the right chart and you order countries by the private to GDP or by the change in inflation before the monetary policy tightening took place. And then you ask the probability that they ran into a crisis in a subsequent period. And there is a big difference here, almost a 20-30 percentage points difference in the probability of running into a banking crisis as you tighten monetary policy. So we have to think of 30% probability when you're in the high private credit to GDP ratio, or 30% where you're in the high change in inflation ratio. It's obvious, it's predictable. And note that I'm not stressing here in some sense the real interest rate. I'm purely stressing here the nominal interest rate. So my story is about the debt service ratio, which is a nominal concept, taking away disposable income, but also creating stress as a consequence on the economy as a whole and on the financial system. I don't know how much time I'm going to get from Fernanda, but if I do have still a few, I want to get into the policy. What can we do in the context of that? And I think people are at this point a little bit queasy about to do something on the prudential side, because they think they may actually make the economy worse, because if you tighten today prudentially, you're going to diminish credit, and they may actually set in motion, in some sense, a bad feedback loop in which the economy starts to do worse, and then the recession gets worse, financial stability gets worse, etc. So what we did was to say, well, is that actually the case? When should you not stop doing prudential measures, either of a micro or a macro prudential side? And what we discovered here is that you can continue to tighten on the prudential side quite a bit. It helps you both in terms of the economy, because you do want to slow down the economy, but it helps you also a lot on the financial stability to avoid exactly those crises that otherwise would be happening. So what we do is here, we look more or less over the same period, slightly shorter because macroprudential wasn't always there, in terms of the deployment of prudential measures. And then we ask, did they tighten, and what form? I'm not going to get into the detail, there are different types of measures. And the tightening did occur throughout the monetary policy tightening period. So people didn't stop, countries didn't stop because they realized the benefit of it. And it does show up. So if I now go back to my earlier chart of what is the probability that you run into a crisis, and then you ask the question, did you tighten before or not your macroprudential or microprudential policies, you do see a significant reduction in terms of whether the likelihood of crisis is diminished. So you can, everything is relative here, 5, 10 percentage points, 10 would be a lot, but less probability of a crisis if you stay with the tightening. And particularly so if you are in these high debt, high inflation regimes, because then the risk and the impact is actually higher, so you're better off. You can do it in many ways. I mean, I mentioned earlier the type of tightening. Here I'm going to differentiate in a very broad sense between capital measures meaning aimed at the banks, so creating buffers at the banking system, rather than trying to target the loan-to-value ratio at the borrower level. I'm trying to create buffers at the bank level. And those actually, at that point in time, are probably the ones that you want to push the most, because they're going to give you the biggest reduction in the probability. You can see it from the right panel, and in the bars there, they're significantly lower, so they reduce even more so the probability of a crisis in this period of monetary policy tightening. So let me stop here. It's really to set out the big picture in terms of where we are. Household financing, important component. Obviously, it varies a lot across countries, so it's very hard to tell in individual stories. But nevertheless, there is this larger channel that you should be aware of. But also in the context of high public and corporate debt, we cannot see the offsetting factors occurring from those parts of the economy. So the combination is probably even more lethal than we would have thought otherwise. Nevertheless, there is still some scope on the macro-prudential side to create a little bit more room on the monetary policy side. So this separation principle of separating monetary and financial stability objectives is still feasible within this time period. It's not easy. We need to do more, and this is where we, in some sense, I want to end up. There is a research agenda here in terms of doing more on heterogeneity, doing more on what's the value of the net worth, and doing more on the country differences. But let me stop here. Thank you.
Great, thanks for the great presentation, Stein. We turn now to Amir.
All right, first I'd like to thank Fernanda for that great introduction, and I'd like to thank the organizers of the conference for having me here. It's a real honor and pleasure to be here. This is a paper that we've written, an academic paper designed for publication, called Consumption Smoothing or Consumption Binging, the Effects of Government-Led Consumer Credit Expansion in Brazil. Just to give a quick shout out to my co-authors, Gabriel Garber, who's here at the Central Bank, Atif Mian and Jacopo Ponticelli are my co-authors on this work. So the motivation of this paper, I think Stein has set the stage really well for me that we should care about expansions in household debt. They tend to be something that can predict severe economic downturns. To make this a little bit more about, in this paper, about developing emerging economies, one of the interesting aspects in emerging markets is that there's oftentimes a very prominent role played by the government. So for example, in recent years, there has been real estate designed credit expansion programs in Malaysia and Pakistan, which is actually where my parents are from. And in Brazil and China, we've seen large pushes of credit operating through state-owned banks. And the real question we have here is what explains the very large take-up by households? So if there is an expansion in credit availability or a loosening of borrowing constraints, why would households be so elastic in their actual borrowing? I think we kind of know from the existing research that they are very elastic, but why? The traditional explanation, which I think most economists start from, is that in some countries, credit markets may have issues and they may not efficiently allocate credit to households that need to smooth consumption. And that's the kind of traditional explanation, which is more, I would say, a good explanation, that maybe the government needs to step in order to fix credit market imperfections. A more worrisome explanation would be that perhaps households are present-focused, perhaps there's behavioral biases that lead them to being very elastic in a way that maybe they'll regret ex post that they borrowed so much. And in such an environment, you may worry that governments that have shorter-term focus may use such programs to kind of boost consumption in the short run, even though it may not end well in terms of when the bill finally comes due. And we wanted to think of an environment in which we can kind of tease out which of these is more powerful in explaining the patterns. And I think the one that we are going to look at is what happened in Brazil from 2010 to 2014. So those of you from Brazil probably know this well, but just for everybody, in 2010, there was a shift in the composition of credit from kind of an even growth between private-owned banks and state-owned banks to one in which government-owned banks really drove the rise in credit from 2010 to 2014. This is going to be something we're going to explore to try to answer this question of why households are so elastic in their take-up of credit. So what do we bring to the table here? Well, we bring a new data set, and again, I want to thank the Central Bank of Brazil, which was instrumental in the creation of this data set, Gabriel and all the others that helped with it. It's a household level credit data set that basically covers every formal credit relationship that households have. So it's a very excellent data set on the credit and who's getting credit and at what interest rates. It also has a pretty good measure of consumption, credit card expenditure, which we show lines up pretty well with overall consumption patterns. Those of you familiar with research on Brazil know the Reich data. The Reich data is fantastic and really helps us to get the wage, education, age, and occupation data. And we're also going to use some survey data to confirm some of our measures of financial sophistication. The empirical strategy we're going to use, as you can see, this is an aggregate policy change. And so the microdata are only going to help us to the degree that we can sort people into who is most exposed to this credit expansion by the government. We're going to rely on people who work in the public sector, and we're going to explain why that's a good measure of exposure to the program. And the key innovation in this paper relative to the existing literature is to look at the heterogeneous effects across people who are likely to be constrained and people who are likely to be less sophisticated in understanding the terms of the contract. And that's really what's going to be the major contribution, hopefully, of this piece of research. So again, briefly, big politically motivated expansion in government, in lending by government-owned banks, especially to the household sector, starting in 2010, 2011, and continuing until the very severe recession that Brazil experienced from 2014 to 2016. Where was it concentrated? It was concentrated in a product called payroll loans, in which the collateral actually comes through the Social Security Administration here in Brazil, where you can actually garnish the wages of individuals when they pay. In the US, those of you familiar with the US environment, we would call these a payday loan, but they're very uncommon in the US, and they're only for very low-income borrowers. In Brazil, this is a very common product that middle class, even upper middle class people use. Okay, the real interest rates during this time period on this credit were high. They ended up being about 20% real interest rate, even during the credit expansion period. How did it happen in practice? This is one of the most interesting aspects of this program. It wasn't that any formal credit constraint was lifted. You might think, oh, there actually is a limit on how much people can borrow as a fraction of their income, and you might think you lift that limit, and that's how you expand the credit. That's not what was done here. In fact, this was more of a push, especially via advertising campaigns and also via bank correspondents who were paid by commission. You can see the advertising expenditure push by the government-owned banks in this picture, where you can see that starting in about 2010, 2011, you see a massive relative rise in expenditures on advertising for household credit products by the state-owned banks. So what are we going to do here? We're going to use an empirical strategy designed to use public sector employment as a kind of difference in difference strategy for who's really exposed to this credit push coming from the government-owned banks. The logic is that public sector workers have better collateral for payday loans or payroll loans precisely because their incomes, and this shows up in the Reich data very clearly, tend to be more stable. And so they're better credit products, better clients in some sense if you have collateral based on income. They were explicitly targeted actually in advertising campaigns. This is just an anecdote, but it's very common that you can see a lot of the advertisements actually even mention that this is a particularly good product for public sector workers. The good news for us as empiricists is that public sector workers in Brazil are a very diverse population. It's not like we're focused just on one part of the distribution. A lot of people work for the public sector across the age distribution, across the income distribution, and so we have a lot of nice variation we can look at. Of course, those of you who want to look into the empirical strategy, public sector employment is not randomly distributed. That's what we would like as empiricists. Public sector workers vary on very important dimensions, and we transparently show those in the paper. However, there are a number of things that are going to allow us to hopefully tease out a causal relationship. I think when you see the timing, it's going to leave probably less doubt that this really is what's going on here. But just so you know the things we've done, given the really excellent data that Brazil has, we can control for a lot of fixed effects in terms of age, occupation, wage, gender, a lot of fixed effects that can allow us to absorb variation. So we're really comparing public and private sector workers who work in the same occupation, who are the same age, same income bracket. So hopefully that's kind of convincing. I'm going to show you that there's basically no difference before the intervention in 2014. The data go back to 2003, so we can really trace the whole cycle. One of the other tests we can do is the Quadja-Mian within borrower fixed effect strategy, which is we can fix the borrower and show that the same borrower is shifting their borrowing dramatically from private-owned banks to government-owned banks starting exactly in 2011. So by that, we can strip out any individual level credit demand expansion, focus on the same individual is now shifting their credit composition, which we think is pretty convincing that this is coming from a credit supply effect rather than a credit demand effect. Here's the results. So the initial specification I'm going to show you is the household debt to income ratio of an individual I. We fix income in the base year, which is 2010. So you can see the evolution of debt by scaled lagged income. And the betas from this specification are what we're going to be showing you, with 2010 being the omitted year. So here is the basic effect. So again, what you're seeing here is the diff and diff, the difference in difference for for public sector workers. How much more are they borrowing relative to the same private sector version of themselves? And you can see I'm showing you both how much they're borrowing from government-owned banks and how much they're borrowing from private-owned banks. So if you add these two, that would be the total effect. But importantly, we see not only are they borrowing more, but they're borrowing more uniquely from government-owned banks. And the timing matches up perfectly with the intervention. And so this is kind of what we would call a first stage, where it's pretty convincing, we think, that the government-owned banks are pushing credit differentially to these public sector workers. I'll skip the regression coefficient just to show you it, but just to give you a sense of magnitude, it's a 0.15 increase in the household debt to income ratio. So that's a 15 percentage point increase, which you can benchmark with Stein's figures internationally. That's a pretty large increase, a 15 percentage point rise in the debt to income ratio. Just to give you some context, for example, China over the last 6 years as a country has seen about a 23 percentage point rise in the household debt to income ratio, which is essentially the largest in the world. So this is a very large relative increase in the household debt to income ratio that we saw because of this policy. We can do it by type of loan. Again, this is due to the excellence of the data really coming from the central bank, and we can show that it's all payroll loans. That's where it's coming from. That's the real source of this rise in the diff and diff. So let's get to the heart of what we're trying to do here. So far, I've shown you things that we kind of have known in the literature. A lot of people have isolated credit supply shocks, shown households are very responsive. That's not a surprising result. It is actually quite surprising in the permanent income hypothesis that they're that elastic. But in terms of what our state of knowledge, I think a lot of people would appreciate and predict that this would happen. What's harder to know is why. why are they so elastic in their willingness to borrow more when credit is made available? The first explanation we often have is that households are credit constrained. They would like to borrow more given their high future income in order to smooth consumption. The welfare effects of such a reason would be obviously positive. We're making it easier for households to smooth consumption. The credit market in Brazil, maybe before this government intervention, was not good at allocating credit to households, and so this is a positive intervention. Right away, that story doesn't really seem to fit. If we look at the way the actual policy was done, there was no explicit change in any borrowing limit. In fact, real interest rates remained very high, 20 percentage points throughout. In fact, real interest rates almost didn't fall on these products as the credit expansion proceeded. Furthermore, there were already restrictions on how much public sector workers could borrow via payroll loans, and almost none of the borrowers were even close to the constraint. So it wasn't like people were actually constrained from borrowing more. There's an interesting question about why they weren't borrowing more. Anecdotally, it seems like people were not fully aware about how much they could actually borrow under this product. The way we're going to try to test this borrowing constraints view is to measure in the data who we think is the most constrained. And the idea of sorting people by who's constrained comes straight from the permanent income hypothesis. The idea is the people who are constrained are people who have high future income relative to present income, which translates in the data to people who have a high income slope. And the Reich data are excellent at doing that, because I can pick you in, say, 2010, and I can show the counterfactual of you in 10 years. Because I can see people who are working in your same occupation who are 10 years older than you. So I can construct your income slope out of the Reich data, and then we can ex post look and see whether it matches, and it matches really well. We thought this was a pretty obvious idea. We couldn't find it in the literature, so I hope that that's a contribution, that this is a good way of measuring who's likely to be constrained. Okay? So just to give you a sense of how this works, this is the income slope you would expect at every given age group. We start at 20, so most 20-year-olds would expect higher income in their future. However, if you're in your late 20s, a little bit less. If you're in your mid-30s, the slope is even less. Once you hit your 40s, I'm 46, so I guess bad news for me. We can kind of expect a constant income profile. And then, of course, once you get into the upper age brackets, you expect a negative slope. Here is the income slope by workers' age. As you'd expect, the slope is quite positive for young people and then goes down. So what this means is now I can sort public sector workers into people who have higher income slopes and lower income slopes. And again, the credit constraint idea would be who should be borrowing most when they get this credit availability? It should be the people with the highest income slopes. They're the people who are most constrained from borrowing against what they want. Financial sophistication is harder to measure. Financial sophistication, we're going to argue, is a plausible mechanism given this large increase in advertising, given the use of predatory loan officers, and concerns raised by the regulator in real time. We're going to measure present-focused households using the years of education interacted with an index of familiarity with concepts associated with finance based on their occupational descriptions in the Reich data. So we're going to do text analysis of what jobs they're in, and we're going to count people as being sophisticated if their their occupation titles include the words finance, statistics, math, or accounting. This is an imperfect measure. We would like to have a better measure, but again, this is administrative data and we want it for the full distribution. What we're able to do, however, is to get survey data for a very small subset where they ask more explicit questions like how familiar are you with financial concepts? Are you the kind of person that has a hard time keeping a budget? These are the kinds of questions in the survey. We correlate what we have in the wider sample with the survey, and we find a positive correlation. So I think that gives us some ease that we have measured financial sophistication. So here's the basic result. Here are the heterogeneous effects of financial sophistication and income slope on which public sector workers are the most elastic. The red lines are showing you the borrowing response by the public sector workers in the bottom quartile of the financial sophistication distribution. The blue lines are showing you the borrowing response for public sector workers in the highest constrained or the highest income slope. And you can see that the bottom line results are pretty conclusive, that it's the people who are the least financially sophisticated that are taking on the most credit, not the people who are most likely to be facing a constraint. So we then go to the consumption data, and we basically see that this same group, the people with low financial sophistication, who are public sector workers, see the largest drop in consumption during the recession. And you can actually trace exactly why. You can see that what's fascinating is their pre-tax, pre-debt service income does not actually suffer more during the recession. And that kind of makes sense because public sector workers have more stable jobs. But their after debt service income falls dramatically because they have such larger debt burdens because they borrowed so much during the boom. So that results in a lower consumption. We can then look at the total time period, 2010 to 2016. We can show that this group of the population had a lower average credit card expenditure and higher average consumption volatility. And so with that, it's an ex post statement, but it's pretty hard to argue that these people were made better off. They had lower average consumption and higher average consumption volatility because of this big decline in consumption during the bust. So again, this is a cautionary tale. We're not to say all credit expansions have to end this way. And I think we're not trying to take off the table that there are credit constraints and that some policies may be able to help people through loosening in credit constraints. But in this example, it does seem like this policy ex post actually harmed some of the people who took on most of the debt during the boom. Thank you.
Thank you for the great presentation, Amir. So before we open for questions from the floor, I'll just abuse my position and make a question to each one of you. So Stein, I think your charts show that we have come a long way since the great financial crisis. Implementation of Basel III has helped to lower in some sort the vulnerabilities, the kind of vulnerabilities we saw in the past. Where do you think next steps lie in terms of dealing with the vulnerabilities you flagged in this current environment of high interest rates?
Well, so we didn't finish Basel completely in the sense that there's still some issues to be implemented. So we always in Basel say when we want consistent and timely full implementation of Basel III. So we're still waiting for some countries to sign up for that part of it. But nevertheless, no, I think you're right. We have reinforced the banking system significantly. And there are these questions. Interest rate risk obviously is in that area. But we still have to look at more carefully. But I would point towards the non-banks as being then the next question where we need to consider. We have had a big growth in the non-bank sector for the last 10 years. Non-banks people typically associate with the US because the US has always been called the market-based financial system. But if you look around the world, the non-banks have grown also in other parts and actually more rapidly there, such that on a flow basis, it actually is above 50% even in the euro area. And I think it's also the case in many emerging markets. And there we don't have the same, we don't have Basel III equivalent for the non-banks. And now, of course, that's a very heterogeneous group of actors there. You talk about pension funds, insurance companies, leasing companies, what have you. So I don't want to start to cover all of those issues. But I do think in the what I call the market-based component of it, so where you see the use of collateral, where you see money market funds, where you see open-ended funds, we have a serious risk still that in the context of high interest rates, it's not that these funds wouldn't benefit from it. It's more that we can see liquidity stress periods. And we've seen quite a few of them already in the last 2 years. That was not related necessarily to interest rates, although some of them were. But even if you go back to the dash for cash in March 2020, we had the gilt crisis, we had the commodity stresses. These are symptoms that are coming up too often and too frequent. And then, unfortunately, we don't have a good regulatory toolkit, so we end up, we meaning the central banks, having then to intervene ex post and provide liquidity support to kind of bring the prices that are in this sector and depressed back up to normal levels to deal with that. So I think we need to do more. We've done money market fund reform. We have to do the open-end reform as well. We have to look at the margining practices in CCPs. But I think what we need foremost is kind of a more holistic view of systemic risk in that part of the financial system. It's hard because the regulators out there are more security regulators, so they have a different mindset, and it's perfectly fine. They have to think of investor protection, they have to think of transparency, market integrity. But in the context, sometimes you lose track of the overall stability issues. Now, we haven't seen, major accidents, but the gilt crisis came out of the blue and we didn't anticipate it. Now, of course, you can say the same thing on the banking side, we didn't anticipate it there. But I think we have less insight in the non-banks that makes me more worried. So we should be doing a little bit more there.
Thanks. Yes, NBFIs remain an issue to be tackled. Yeah, I agree. And Amir, you mentioned China, and it's always a fascinating and very hotly debated issue, the credit cycles in China. We just saw how the real estate sector there kind of crashed. And so could you share with us a little bit of insight into how consumers in China are faring? Are they present focused as well?
Yeah, thanks, Fernando. Yeah, so some of the recent research we've been doing is thinking very carefully about the situation in China. And I was joking with Fernando beforehand that, you know, at some point we became the go-to researchers on rising household debt across the world. And so for 5 years, people have been asking me what's going to happen in China. And I would say, I don't really know much about China. So I used the last 6 months to really kind of get deep and figure out as much as I could. And the interesting thing about China is that, you know, in the overextended property sector is just striking, just how much. During these household debt booms, which is true in Brazil from 2010 to 2014 as well, you typically see construction booms. And oftentimes that might be a positive benefit. Maybe more housing stock is actually needed, especially in emerging markets. The extent of the housing boom in terms of construction in China is truly unprecedented. I think the closest thing that I've seen in the data is what happened in Spain from 2001 to 2007. But other than that, it really is quite striking. And I think the property sector is overextended. And I think there's less of a risk of a sharp financial crisis, of a real big crash in China in terms of the real economy. But I think so much of the production sector is designed towards fueling that real estate boom that I'm quite pessimistic on the kind of 3 to 7 year growth on what will happen in China. On the household side, I think credit was not as easily available during the boom. For example, it's almost impossible to take out a home equity loan in China. So pretty much the debt is to buy houses. And the other thing that I think is worrisome for China, there's some great research by Hui Shan, who was my colleague at MIT when we did our PhDs together. Now she's the chief China global economist for Goldman Sachs. They have these nice graphs showing how closely linked consumer sentiment is in China with the housing market, which you might think is obvious, but it's actually not the case in the US. In the US, for example, consumer sentiment is very closely related to gas prices for whatever reason. I walk to work every day, so I don't quite understand that. But in China, they're very, very closely related. And so I think that bodes very, very poorly for how consumption will evolve in China. And it's interesting because despite the reopening and people said, oh, China's going to really come roaring back, the consumption data has been weaker than people expected, and I think it's precisely this reason that households have been burned very badly by house price declines, and I think they're more kind of scared in terms of spending in the future.
Great, thank you very much. We now open to questions. Anyone? Carlos?
Thanks for the great panel. I have a question for Amir.
Fantastic paper, Amir, very interesting. You pitched, as you know, like a household finance thing, but I think it's useful to mention that this had a macro dimension here in Brazil, and it's nice, quote unquote, to see the seeds of the 2014, 2016 recession, you know, early in terms of sort of bad policy design, if you ask my opinion. So I wanted to ask a little bit about policy implications, right? What would you recommend? You know, is more like suitability of products, or just investing more in financial literacy, or actually trying to avoid this kind of, you know, credit expansions aimed at just trying to boost aggregate demand, but without taking into consideration these other issues? And finally, a joke, if you allow me, for a lot of people, it might be kind of funny or curious to see a paper like that written by a Chicago professor, but there's nothing unusual about that. So thanks a lot.
Maybe we'll take a couple. We have one right here on the forefront.
Thank you very much for both very interesting presentations. This is also to Amir. I am more in the academic side, so I tend to go that way. When you were presenting, I have no idea about the arrangements in Brazil, but a third possibility that comes to my mind why people may like to borrow in state-owned banks is because they expect that the repayment rate is going to be lower in case that there is some delinquency. They won't be enforced by any way by the government. Is there any way in the data that you can rule out that possibility? And another question that came to my mind is that when you were presenting your conclusion, it seems to me that more than being a state-owned type of policy, what made the difference was the campaign. If this type of loans are profitable, I am curious why commercial banks did not exploit it better if just they have to do some advertisement.
Thank you for both questions. On the first question, one of the, you know, Atif and I have written a number of papers on the dangers of household debt expansions. And I want to make sure everyone understands that that's more of a cyclical argument. And I think we've gotten pushback, rightfully so, because we don't mean to imply this. It's clearly, I know Chris Sims, for example, at Princeton always says to us, yeah, but if you look at the cross-sectional correlation between you know, any measure of GDP per capita and household debt to GDP, it's a very positive relationship. And I think that's a very important point that I want to make sure and emphasize. We're not saying that it's a bad thing that the financial sector figures out how to get people to buy homes more easily, how to smooth consumption. That's why I love your question, which is, how should you do it? And I think that, you know, I think it all boils down to the fundamental economics of the situation, which is, do you really think that the reason household debt is expanding is because it's helping to fix a constraint on people who actually have pretty good income prospects, but just can't borrow, you know? And I think there's this old joke, which is a little coarse, but I think it helps make the point, which is if your income is always low, you're not credit constrained, you're just poor, right? And I think that's like a big important point, that a lot of the policies should be designed to get people higher income, right? That should be the first and foremost policy, and not necessarily to get people to borrow temporarily. And again, just to make sure I'm being clear, if the goal is to boost consumption for people who have low income, just do transfers, right? I mean, it's a simple thing. Do a fine, maybe it's more politically unpopular, but at least it's more transparent, and it doesn't have this kind of clawback mechanism. And so hopefully that's my best take. I mean, every country is going to be different, and you know, there's some policies that are good. So for example, the creation of the 30-year fixed rate mortgage in the United States after the Great Depression, I think was an enormously positive thing to do. You know, the Great Depression really robbed people of homes. People needed more stability. They didn't want these huge bullet payments after 5 years. So it made sense to do that. And so I think you're just trying to do what you can do to facilitate consumption smoothing in a good economy. On the second question, that's a difficult question. So just to repeat, the idea is, are people expecting that perhaps they'll be bailed out by the government and so they won't actually have to make those payments? That I don't know, and I think it's very hard to test because obviously that means forming expectations about who's going to be in office and who's going to be more sympathetic. My personal take is that's probably there to some degree, but I don't think it can. My personal take is I just don't think people are that sophisticated in thinking through it. Maybe that's a little bit of, well, I'm not going to think about it because at the end of the day, something will come and it'll be okay. Maybe that's some version of this, but it's hard to test empirically.
Take two more.
Hello. Thanks for the presentation. My question is for Stein. And you've showed that monetary policy impact is higher when debt levels are higher in the private sector, but which makes sense, of course. But how do you reconcile with the fact that sometimes private debt is actually boosted by fiscal expansion of some sort, right? So, and especially in emerging markets, what happens a lot, and maybe that's the case now in some economies, and even in developed economies now during the COVID, is that when you were doing the hiking process, you were also doing some sort of fiscal expansion, increasing income, and as a result, reducing the debt to income, or so somehow also diminishing the power of monetary policy via a looser fiscal policy. So how do you see this net effect, or is just an intertemporal problem? And I don't know, in the longer run, the results are still valid? That's my question.
Thank you. The next one.
My question is also for Stein. I would like to ask about your point about macro-prudential policies. It's usually the case that, especially, for instance, when we talk about capital ratios, it takes a long time to banks to build capital. And macro-prudential policies are usually seen as a way to prevent the build-up of risks. So the question is, how do we operate this when the risks are already there, as you showed? Thank you.
Okay.
Okay, thanks very much. So, I mean, on the fiscal side, we can cast it even broader in some sense. Is monetary policy and fiscal policy, are they working the same way, in the same direction? Actually, this is a relevant question today because there's still quite a few countries that run fiscal deficits, in part because they support the energy price shock and the consequence of that. They subsidize some elements of some parts of society. And then you really have to ask yourself, isn't fiscal policy doing actually the perverse thing? Because it's adding to demand. You can say, well, it's supporting poor people. Well, no, it doesn't do that exactly, because it gives it to everybody in the economy. If it were more targeted, that would be obviously a better thing to do. So will we get there? I think in the end we will get there, but for the wrong reason possibly, that the monetary policy tightening is also going to tighten the fiscal purse at some point, because there's debt sustainability. At some point they're going to consolidate, but it would be much nicer or better if it were a little bit more coordinated, quote unquote. And that's not a call for a formal coordination, but it's nevertheless taking into account that one can't be pushing on one hand and the other one trying to offset it at the same time. So your specific question is really relevant for the COVID period, of course. Now, arguably, there was no choice but to be very fiscally generous for everybody during that period in time. I think many countries have admitted that exposed, we should have been able to do better. But we still don't seem to be able to learn the targeting of the support measures. There was work by the current chief economist, not by Gita, but by Pierre-Olivier Corinchas, who actually showed that if you did targeted support to the private sector, to the firms on the fiscal side, you could do with a quarter of the support and achieve the same macroeconomic impact. So all these high levels of buffers in both on the private, corporate and the household side is because we didn't target exactly, because otherwise we wouldn't need to have these buffers in the first place. So we still need to work a lot more to make these things work better. Macroprudential, I mean, I think of macroprudential, there's both trying to prevent the risk to build up. I think in policies that are aimed at financial institutions are not the best for that. You really have to think more of those that are aimed at the borrower. So I think of there as loan-to-value ratios, particularly in the mortgage sector, as being very good. And they may have to be actually not so cyclical, but rather being constant. Let's say you have an LTV of 80% more or less ever. And on that basis, you prevent the buildup of risk. I think the ones in the financial sector are much more the buffer type. So that's why in my argument that you can still build buffers at this point in time is exactly because you don't want to prevent anymore. The risks are already there in the system. But what you need to do now is to build the buffers. And the buffers, don't forget, banks are making a lot of profits at this point in time, right? I don't know the exact numbers in Brazil, but that's true in many of the countries because of the higher interest rates. Don't have them distribute those profits to the shareholders in the face of what is going to be a tough time going forward. So try to have them build the buffers internally from that money that they have anyhow.
Do we have any more questions? One?
Thanks very much. My question is for Amir. Do you have any ideas about the component of financial sophistication that might have been affected by the intervention? Was this a story that people didn't know how to ask for a loan, or they just didn't know that they could ask for a loan?
Great question. So there's a literature in behavioral economics on the importance of advertising, especially, and how it interacts with financial unsophistication. And it's really quite compelling so I mean, the bottom line answer to your question is I think it is people who are not necessarily aware, or it's not even really in their choice set to think of going out and getting a payroll loan. And then seeing the advertising may tell you you can get one, but not transparently show what's the actual real interest rate, what's the payment, the repayment plan. One of the cross-sectional tests that we're planning on doing in the next round is to explore, as of 2010, I should be clear, the payroll loan was around before 2010, really it was 2003 when they really took off, is to see if people who already had payroll loans were less subject to this kind of behavior of borrowing so strongly. That maybe people who already understood what the repayment profile, what the real interest rates were, are the people who didn't have a strong take-up. So I do think the advertising had to have been instrumental. I wish, if there were one thing I wish about this paper that we had better data on, is exposure to advertising. Unfortunately, it looks like pretty much everyone's exposed to advertising. It's hard to find cross-sectional variation in Brazil, and I was thinking that when I walked in the airport. I mean, there's advertising, right? Like in any country. So I don't really know how to test, but my hypothesis would be is if you somehow could have someone who was not exposed to that advertising, they probably would have been a lot less likely to take on the credit.
Great. Okay, so maybe we'll finish on time for lunch. And I want to thank our two great panelists for a lot of insightful presentations and responses to the questions. Thank you very much.
Agradecemos, então.
We thank our mediator and our esteemed guests. We'll have a quick break for lunch that will be served in the hall of the auditorium. We'll be back at 2 p.m. at this auditorium. Have a wonderful lunch. Bye-bye.